Morning, good afternoon, good evening. It's Friday, another Friday again, January 12th. Welcome to the latest episode. This is Mark Yu.
This is Wawi Santos. Hello to Mark You and Wawi Show.
And for this episode, we still have the bear on the background. And the title of this episode is Earnings Season Adjustment. So why so? We're gonna take a look at the fact set. Good thing I'm really thankful that FactSet provides these research on a timely basis and for free to investors out there. So, as you may have known, if you're closely following the Wall Street, today's been a busy day. As technically today is what they call the start of the earnings season, as big banks, have reported their earnings. I for sure know Wawi has some exposure to banks like J.P. Morgan. Is that right, Wawi?
Yeah, I have JP Morgan, Bank of America, and other smaller financial equities
Right.
like Upstart. I still have Upstart.
Oh, okay.
I'm thinking about using PayPal next. Um,
Mhm.
I
But
can't remember what else I have.
right. So we're gonna just before we dive into the sentiments, which we also tackle on a weekly basis, and for this week we are again blessed as Reuters have shared their fund flows report. So we're gonna see where the money is going and if the market is reacting accordingly. As some of our listeners may already have noticed, as we have tackled this and followed the fund flows, it doesn't mean that a lot of money is going to one sector that sector is outperforming. It's not usually a direct correlation. So on we go to our earnings expectations adjustments. So this is a fact set. There are three articles that we're going to share in this episode from FactSet, which is very, very helpful if you are a long-term investor in the stock market here in the US. Oh, by the way, we are not financial planners or registered, so uh, do not use this as an investment advice. Feel free to seek other investment advice. But me and Wawi are healthcare professionals, and we just like to share our passion and learnings in the stock market through YouTube. So FactSet published the study on the 5th, about a week ago. It says analysts made larger cuts than average to earnings per share estimates for S&P 500 companies for the fourth quarter. Fourth quarter meaning the last 3 months of last year. So looks like while these experts or analysts are setting up lower threshold for companies to beat. That way, the stock price won't drastically fall or lose altitude. What do you think of this phenomenon, Wally, as analysts are lowering their targets or company earnings per share targets?
Well, that goes in line with the current situation right now. Um, with supply chain disrupted again at the Red Sea, Panama Canal, uh, somewhat uh, low level. So there, a lot of these shipping are having to use the land transportation to bring the goods into market,
Right.
and that has slowed down some of it. And of course, the high interest rate for international trade is also affecting some of these companies.
Could be, yeah.
So that's lowering some of the analyst expectations for most of these companies.
Probably so for those companies that have yet to report for sure. But this one is probably on average might be those companies that already concluded their, but yeah, there are still some turmoil there for sure
Oh,
earlier on. Yeah,
you mean the banking
fourth quarter.
sector?
Yes. So for
Yeah, well, those are for
mm,
the charges, like when JP Morgan acquired that company, that bank that was going down, they
right,
had to pay charges to accommodate that
right.
acquisition.
We do have an article coming from Bloomberg that was just published highlighting how JP Morgan delivered outstanding results as a result of that acquisition. But yeah, going back to this article, the answer is yes, regards to the question if analysts are making larger cuts to earnings per share. So earnings per share is what propels the stock price. If company did not beat their earnings per share target, they could face quite a beating from Mr. Market. Regardless, if it's sales, markets sometimes don't pay much attention to that, but earnings, yes. So a lot of analysts are lowering down for the numbers. Those who are interested for the numbers specifics, analysts that lowered earnings per share estimates for the fourth quarter decreased by 6.8%. In a typical quarter for the past 5 years, the usual decline in estimates is 3.5. So analysts are lowering down by 6.8 in terms of setting up expectations. So for the 5 years, usually negative 3.5, 10 years, negative 3.3, 15 years, negative 4.2 if they're going to lower it down. Past 20 years, negative 3.8 if analysts do decide to lower their earnings per share. But this quarter, we are lowering it down on average 6.8%. So this is the largest decrease of expectations since third quarter of 2022. So a huge dip here, 6.9 in terms of this. Very good, the facts that provides this chart. You haven't seen this kind of a drop in terms of adjustment in earnings until at least about 2 years ago. Let me see. 1, 2, 3, 4, 5, 6. 2.5 years. Well, 1.5 years ago. Not 2 years, 1.5. So bottom up EPS, earnings per share. Look at this trend. The S&P 500 is just going up, 4,790, while the earnings per share has been going down since September of 2023. So a little bit of this is the earnings per share. So yep, analysts are definitely lowering down expectations. So what are the industries that have been lowering down? A lot actually is coming from healthcare. 21.3% negative expectations. Materials, negative 13.5. Industrials, negative 9.3 adjustment. Financials, negative. Actually, all of the sectors, except for just two, utilities and information technology. The only two sectors that are still anticipated to deliver positive earnings for the fourth quarter, which is interesting because we just experienced a 9-week rally to the year end. Even before the Santa Claus rally, which was the last week of December, started, the stock market was rallying hard before that last week of the last year. So quite an interesting finding, right, Wawi? That just utilities and IT are the only two sectors projecting an increase in the fourth quarter.
Well, IT is benefiting from tailwind from the AI, you know, buzz. So there's some push towards that. Utilities, I don't know what's driving that, but it could just be a lagging trend. We will see what happens when they report January's
Right.
data.
Maybe they're thinking, oh, they're gonna cut the rates. So it may be too early for that for the last quarter. So we haven't seen actually any movement on the rate since July of last year. So, and more of the expectation by the end of this month when the federal committee meets is that they're not going to do anything about the rates until at least March. Another article from Facts said financial sector quarter four earnings, banks actually lead earnings decline. So this was published just 4 days ago. Financial sector will be focused in the next 2 weeks. 70% of the companies that will be reporting this coming week is coming from banks. So we already received reports from Bank of America, Citigroup, Goldman Sachs, JP Morgan, Wells Fargo this morning. I think I have a screenshot of my So good thing Google comes out with a kind of like notification. So for a quick summary, Wells Fargo beat earnings per share by 37%. Bank of New York beats earnings per share. Bank of America missed earnings per share. JP Morgan actually missed earnings per share. Wow. BlackRock beat earnings per share. So let's see the price reaction. Let's start with Wells Fargo. Wells Fargo is down 3% today. BNY is Bank of New York Mellon. BNY is down. BNY is up 4% today after beating. So Wells Fargo beat earnings, but they still fell. Bank of New York, they beat earnings, but they rose. Let's see Bank of America. Bank of America missed earnings expectation. Let's see their price. Bank of America is down 1%. Not much punished. JP Morgan. Let's look at JP Morgan. They missed expectations. Down. Well, wow. 0.73. Not much. BlackRock beat earnings by 9.58%. BlackRock, well, flat, positive 0.88. So not much reaction for the biggest of big banks there. You always miss any? I guess those are the only few banks that have reported, but yeah, banks lead earnings decline. So according to this article by FactSet, financial sectors is predicted to report the fourth highest earnings decline of all 11 sectors at negative 3.1. I think we went over this right here in the previous article. It's actually projected negative 9.2%. I don't know where it's getting a negative 3.1% here. Industry level. So for the financial sector, there are sub-industries under that. There's insurance industry. So interestingly, insurance industry is expected to report earnings growth. So I think they have a chart down here. Yeah. So only two sub-industries on the financial sectors are expected to register growth. Insurance is expected to deliver 26% earnings growth, financial services 10% growth, and the rest, capital markets, consumer finance, and banks themselves are expected to report negative 21% decline in earnings. So banks, good thing some of the big banks are holding on right now because they are expected to go down in their earnings quite a bit. 21% in profitability decline. But if you're going to look at the future from last quarter to the end of this year's quarter, banks are expected to bounce back. So first quarter of 2024, they're expected to generate 2.4% increase in earnings. Second quarter, 5.6. Third quarter, flat, 0.6% positive. And then look at the fourth quarter, 24.2% jump. Where is this coming from?
I think they're expecting the Federal Reserve rate cuts. They're pricing that in at the end of that quarter.
Yeah. And probably also from the comparison from -3 in the fourth quarter here, maybe they're gonna double, triple, even quadruple that. But that's a huge upside. Hopefully we remember this by fourth quarter of this year about these banks because this is a huge expectation in terms of earnings. So a timely article again from FactSet today, as banks have came out of their earnings. Are more S&P 500 companies issuing negative earnings per share guidance than average for the fourth quarter? The answer is yes. A lot of S&P 500 companies are issuing negative earnings per share guidance for their fourth quarter last year. So if you want to go to numbers, I don't know. Here for the sector, let's see. So a lot of infotech is indicating negative earnings per share, infotech, followed by consumer discretionary, industrials, healthcare materials. So not a whole lot of energy, providing negative earnings per share. Financials, believe it or not, are way on the right, but still on average they are compared to the 10-year. Compared to for the past decade, a lot of companies are lowering their earnings per share. Maybe they want to jump that threshold and not get punished by Wall Street in terms of their fourth quarter results. So I guess we're gonna
Yeah,
jump.
yeah, that's a good play for them. Don't overstate their earnings, so
Yeah.
Wall Street won't expect too much from them.
Yep. Set low expectations.
Lower expectations.
That's the game right now, which is
Mhm.
quite, a little bit troublesome because I guess if you want to provide an impression that your company is growing, you want to be growing in your earnings, not losing or declining. But I guess we'll see if Federal Reserve will come out early this year to provide much more liquidity to the market. So JP Morgan, this is a Bloomberg article that just got published. JP Morgan, despite, missing the expectations, posts record net interest income and predicts even more this year. So expenses jumped 29% more than analysts predicted. Jamie Dimon says inflation may be stickier than investors expect. So JP Morgan closed out the most profitable year in its US banking history. Seventh consecutive quarter of record net interest income. Difference between what banks earn on loans and payout on deposits. It came out to 94.2 billion last quarter. The haul for all of 2024 may rise to 90 billion according to JP Morgan, while analysts have been expecting a 2% drop. So Chief Executive Officer Jamie Dimon is, of course, happy. He says our record results of last year reflect over-earning on both net interest income and credit, but we remain confident in our ability to continue to deliver very healthy returns, even after they normalize. A bit positive touch there that kept the shares barely positive for JP Morgan. So I don't see any more red flags or good things to highlight here. So I guess we're just now going to jump on to our regular weekly sentiment surveys. So American Association of Individual Investors came out with their report for sentiments. Bullish meaning up, bearish down next few months, neutral obviously, that explains itself. So no change. January 3rd, 48.6 bullish. January 10th, 1 week later, 48.6. I don't know what happened to the bullish the survey here. Maybe they fall asleep and they just remained. A little bit increase in bearishness, 23.5 last week to 24.2. So a lot more people, same amount of people are still bullish in the market. A little bit increase in bearishness. Sentiments, greed. So we are still at greed, 71 points from last week's 70 points. So it's still about the same. It increased by a point, not much change. The market momentum, 125-day versus the S&P 500. The averages, we are plateauing there, sort of. Hard to tell, but we haven't moved since a couple days ago, and we're still up there compared to the 125. So what matters is we have broken this kind of like trend here going downhill from last week of December to first week of January. We bounced and now we're kind of plateauing. The stock price strength, you could tell it's going down. There's a bar chart that we're going to share in a little bit, which kind of like indicates some troublesome finding in terms of stock price strength that we're going to share in a little bit. McClellan also is declining despite the S&P 500 plateauing for a little bit. indicating a little bit of a pause at the moment. Put in call options also is pausing. Never increase, never decrease. Same amount of people, same amount of put options being held. Volatility still sub 50-day moving average, indicating that the market is just calm at this point. For the past 5 days, the volatility is actually down 7.8%. I don't know what happened to the market. Let's see. Market is just up 1.7%, despite the volatility being down 8%. Volatility for the Nasdaq is down 6%, while the Nasdaq itself is up 2.8%. Wow. Nasdaq, I guess Nasdaq is doing well despite the very good year last year, right, Wawi? They're still up, trending up for the past 5 days at least.
Yeah, they are, but I don't know how long that will sustain itself.
Yeah, the S&P for the year we're looking at is about flat, 0.81%. And Nasdaq for the year is about flat as well, 0.67. But the past 5 days for Nasdaq is pretty good, up 2.8%. For the groups for the past week, yes, sir, technology for sure. Is it going to be another year for technology? Because right now, technology is the best performing sector, and the worst performing again is energy. So will this be a repeat? Wawi, what do you think?
I don't know how long they can ride on the coattails of AI, uh, but there are some developments out there. It's just hard to tell. It's just hard to predict these things. If you can consider the hype about the Bitcoin ETF as a technology uh, improvement in the sector,
Mm,
then it may push some of these development towards that area, towards some changes in the financial structure. So I'm looking at maybe changes in the financial sector more than the information technology sector.
mhm. Right. Well, I was hoping to see the same thing for technology for year-to-date performance, but actually, when I pulled the chart, healthcare is number one this year, followed by communication services, which is also tech. But that's interesting. Healthcare making a bounce. Um, healthcare, where was it last year? Oh, they were still in the green, positive 5%. They were the sixth best performing sector, but right now, healthcare is number one. Does that indicate that we're kind of heading into a recession? It's too early to tell, I guess. Should be healthcare utility, like last week, right? Your healthcare and utilities were the best performing
Mhm.
sector, but we
Yes,
we
Mark.
rallied, yeah, we have rallied since, and technology is taking back its crown at this
But
point.
United Healthcare is under pressure right now with the increased coverage
True,
for a lot of these senior citizens and uh, sick patients needing insurance,
true. Not more
needing
expense.
coverage. Yeah, so they're kind of down pressured right now in this the largest um, healthcare player out there. So you kind of see what's gonna happen with
Mhm.
healthcare. It's also gonna be pressured.
Right. Well, it's something to keep an eye on for sure. When United Health is one of the largest, I think it's the largest insurer here in the US. Oh, another topic here regarding speaking of technology is Microsoft. So this, I kind of saw this yesterday, but I guess it made its stand finally today as Microsoft overtakes Apple as the most valuable stock in the whole wild world.
That's incredible, right? Who would have expected that to happen?
Mhm.
That is just amazing.
They toppled down the biggest stock or company in the whole wide world, Microsoft, of all companies. So Microsoft, I don't know what the value is, 2.89 trillion as of today, as of the closing, 2.89 trillion. Apple, 2.87. So there's not much difference. Man,
It's just a $3 billion.
I guess that's still a lot of money, but that's amazing. Microsoft and Apple. So I pulled out their income statements from Macro Trends. So good thing this is free. It goes back to about a decade, I think, or at least 5 years, 2018. So this is Microsoft 2009 to 2020, but I have here what 2018. So from 2018, it had 110 billion in revenue, and now it has clearly close to doubling it in terms of their revenue and their profit from 16 billion. That's how many times into 72? More than 5 times
Amazing. Ooh,
to profitability.
unbelievable.
A lot of money. A lot of money. While Apple, look at Apple. From 265 billion, Apple is already doing what Microsoft is barely achieving in its revenue back in 2018, and revenue still grew to 383 billion. That's how much? 383 minus 265. That's $118 billion more. Whereas Microsoft 211, 101 billion more in revenue. Man, these companies are just monster cash sales generator. Profitability from 59.5 billion, it has now jumped to 96 billion, 97 almost, 96.9995. 96.9 minus 59 billion,
43,
about 38,
38.
$38 billion more in profitability. These are just
Ooh,
cash monsters. Really, really good in taking care of their uh cash business, generating cash. So fund flows, finally. Luckily, we have this data available from Reuters, published just this morning. Weekly outflows from stock, equity, or US stock funds rise in caution ahead. So despite the bullishness that we are seeing on the sentiments, fund flows, the money is slowly seeping out. Stock funds. So US investors trimmed positions in stock funds and rolled it into safer money market funds, leading to January 10, exercising caution. They sold equity funds worth a net worth 11.55 billion has been sold, the most in a week since June 21st last summer, while purchasing money markets worth about 4.6 billion. So a lot of money is being pulled right now from stock funds despite the steady sentiment here from American Association. We're not dumping any waters there, but interesting fact. Large cap saw significant withdrawals, 8.82 billion, biggest outflow since March of 2023. Investors also sold mid, small, multi-cap funds, 1.38 billion, 828 million. Yeah. So a lot of money has been pulling out, Wawi. Does this kind of like, should we pay closer attention to this, or should we start packing our bags and
well, we're not gonna pack. Well, we may pack our bags full of money and invest it in the other regions of the globe,
Mm,
but definitely keep some here. Um, Last year, there's a lot of movement of money flow into equities late last year. So I guess just coming in with the CPI, PPI report, they started pulling out before that came out because most of them are expecting probably higher inflation.
what kind of reminds me too, Wawi, is like, since it highlighted it since mid-March, the largest withdrawal from large cap. That reminds me of the bank panic when the banks are filing for bankruptcy.
Oh, let's hope we don't get into that area again. But yeah, the banks are pressured. a lot of these smaller banks are pressured again because they don't have they have depositors that are moving their money away from deposits and putting them on interest bearing accounts,
Right.
higher yielding accounts.
Which they already did too on this part. 9 billion or 4.6 billion went to money market. So in terms of sectors, some investors still put money, 682 million to some sectors. They purchase materials, healthcare, and financials. 568 million materials, 496 to healthcare, 313 to financials. They withdrew 543 from consumer discretionary. So that's what's happening on the stock fund flows, guys. Those are very good information provided freely by Reuters, which we do really treasure. US bond funds drew about 4.9 billion, so a lot of money also piled in. Third successive week going into bond funds, US bond funds. General domestic taxable fixed income attracted 5.23 billion. Wow. Taxable income, fixed income funds. So those are bonds too. A lot of money piling into bonds, looks like, Wawi.
Yeah, just like late last year. Yeah, they've been doing that.
Mhm.
And I'm not surprised about money going into banks because, banks are cheap right now.
Mhm. Short-term investment grades, high yields received 869 million and 491 million, respectively. Government, short, intermediate government and treasury funds saw 2.79 billion worth of outflows. I guess investors are not getting a good deal when they look at treasuries now and short and intermediate government treasury funds. So that's it for the fund flows. Okay, global money markets see third weekly inflow out of US inflation data. So yeah, this was highlighted earlier. Global money market secured a 57 billion worth of inflows this week. That's pretty good. So by region, it says here, this is another article, by the way. It was quite helpful. They published it just this morning as well. By region, European and Asian money markets were in demand. 26 billion and 24 billion going to them. Wow. European and Asian money market. Maybe because they have higher yields. US funds only received 4.6 billion. In the stocks globally, now we're talking about globally sold 7.7 billion worth of funds. Second consecutive week of outflows globally. Consumer discretionary faced outflows of 614 million, biggest weekly net selling since September 27 of 2022. Healthcare and metal mining sectors drew inflows. Healthcare and metals and mining, 582 and 556 million. I think there's some big money moving here that knows what's up. That's my my assumption.
Well, I guess they know that the Fed would start cutting rates by spring.
They're preparing. They're setting aside cash dry powder. Global
Yes.
bond funds globally garnered 10.77 billion. Interesting. Among commodities, precious metal funds suffered 813 million, biggest outflow. Lots of movements here. Okay. So this is one of the Federal Reserve Chairman, Fed's Master, this was published yesterday, says March probably too early for a rate cut. So this is one sign that we need to pay attention to for sure. I think March is probably too early in my estimation for a rate decline because I think we need to see some more evidence. I think the December CPI report just shows there's more work to do. and work is going to take restrictive monetary policy. So definitely a hawk among the federal boards. A hawk
Mhm.
means like he or she likes tougher measurements, higher rates to curtail inflation. So just something to keep an eye on. One of the federal mester. What do you call it? What's her first name? Cleveland Federal Reserve Bank President Loretta Mester. So some of the charts. So we're down to our last 2 minutes here. So this is what I was referring to earlier. According to bar charts, is saying, only 83% of S&P are now trading above their 50-day moving average, starting to head downward, much like it did in the summer. So if we're going to look at the summer graph here, when everything started selling off, that's where we're clearly kind of like mirroring that period. So this is not to say that we're going to experience it again, but something to keep an eye on in terms of momentum and technical drawings. So another negative indicator here. Well, the bond king Jeff Gundlach saying that the S&P 500 is forming a double top. So a double top means a sell-off is in the horizon. Well, double top and double bottom. These are reversal chart patterns. So we've been climbing up. So now we have reached 2 periods of similar tops, 4756. We have to pierce through that on the upside to break that curse, or we'll see. So this is a chart from Zero Hedge. He's saying the supercore CPI has bottomed. So this is a little bit troubling. So if inflation starts to rise again, we're gonna probably see further rate interest holding at the high end instead of rate cuts by March. All right, what do you think? We're down to our last few seconds. I apologize for the short period, and I appreciate your time, Wawi, for joining us today and sharing your thoughts on the market.
Well, thank you too, Mark. This is actually a very challenging market to try to understand, but hang tight. Things always do better after after these cycles are done.
True. Stay invested, guys, and always do your research. Thank you again, Wawi, for your time. Again, this is Mark Yu signing out.